A large majority always says that they do not have enough time to follow the finances of companies, and that's why they don't invest in the stock market. So in today's video, I want to talk about ETFs, diversification within an ETF portfolio, and changing investing strategies by substituting ETFs. I will also talk about the best ETFs for long-term wealth generation, in my opinion, for people with various risk tolerances. Hey friends, welcome back to the channel. My name is Ahsan. I'm a researcher, and on this channel, we discuss business and personal finance in Germany. Let's begin with what is an ETF. An ETF, or an exchange traded fund, is a basket of securities that trade on the stock market just like a stock does. Similar to stocks, ETF share prices fluctuate all day as the ETF is bought and sold. ETFs can contain all types of investments, including stocks, commodities, bonds. Some offer US-based holdings, some international, and some offer a mixture of both. Okay, this was the definition of an ETF, but what exactly are ETFs? Let me give you an example of the S&P 500 ETF. The S&P 500 ETF follows 500 of the biggest publicly traded companies in the United States. So when you buy one share of this ETF, you buy a small percentage of all of these 500 companies. The percentage of each company varies within the index. Buying 100 euros worth of S&P 500 ETF, you would be buying 7.02 euros worth of Apple, 5.78 euros worth of Microsoft, and 2.02 euros worth of Tesla, and other smaller portions of the remaining companies. As I mentioned, there are different kinds of ETFs. Some follow indexes like the S&P 500, FTSE 100, DAX 30. Some follow specific sectors like the S&P 500 technology sectors, and many others. Let's talk about building an ETF portfolio. Most people in Germany follow the 70-30 rule within their ETF portfolios. 70% of the investments go to the developed world markets, and 30% of the investments go to the emerging markets. This way, most of the world's economies are covered. The distribution is 30-70 because most of the growth at the moment is in the Western world, and the risk is also relatively low. The lower percentage covers the developing markets, where the chances of future growth are really high, but with this also comes a higher risk level. Some argue that if you believe in the Western economies, this percentage should be different. So an ETF consisting of just Western world economies makes sense to them. Comparing the emerging markets with the US-based S&P 500, we can see that there are segments where the emerging markets outperform, but during the last couple of years, the S&P 500 has outperformed the emerging markets. On further investigation, even within the European markets, the S&P 500 has outperformed the German DAX and the British FTSE by more than 100% in the past couple of years. And this trend might continue for the foreseeable future. Up until now, I have only talked about the Western and emerging markets and the various indices. What about individual sectors? But before I continue, please hit the like button and consider subscribing. Within the entire GICS structure, there are 11 sectors, 24 industry groups, 69 industries, and 158 sub-industries in which all major publicly traded companies are characterized. Comparing the 11 sectors within the S&P 500, we can see how they have performed in the past 5 years. The technology sector has performed the best in the last 5 years with a growth of 151%, while the communication sector was the worst performer with 0% growth. You may be tempted to invest all of your money in the technology sector, but if you look at the performances of all the sectors in the past 6 months, the numbers show a different story. Here, investing in the energy sector would have given you the best results with a growth of 19.4%, and with the technology sector, you would have been at a loss of 8.7% within the same time frame. As the economy expands and contracts, so do the performances of companies across the 11 sectors. When the outlook is positive, economically sensitive companies perform better and investors are prompted to buy their shares. If the outlook turns gloomy, investors may sell out of those companies and swap into investments that can weather the economic downturns. This practice is known as sector rotation. Due to this sector rotation, being heavily invested in just one sector might not be recommended for someone who has an ETF portfolio. When it comes to diversification within an ETF portfolio, It all depends on how safe you want to play. As I mentioned, technology sector is more growth oriented but riskier compared to a broad market index like the S&P 500. Some commodities are cyclical. Just look at the prices of silver. In the start of 2020, silver prices went to the moon and kept rising, but now they are back to the 2019 levels. So long term they don't make much sense compared to other types. The 70-30 rule is good, but there is no hard and fast rule. And you can always invest in different kinds of ETFs as long as you know what you're investing in. You might have seen me flip-flopping between various strategies from growth stocks to ETF investing and dividend investing. At the moment, I'm investing mostly in ETFs and dividend stocks. Let me know in the comments if you want me to make an update on my portfolio. So you can always change your investing strategies as you learn and grow as an investor. I have a video here where I discuss this in detail. Let's talk about the best ETFs for long-term wealth generation, in my opinion, for people with various risk tolerances. The first ETF is the MSCI World. This ETF covers a wide array of companies from all over the world. With its vast coverage, this ETF is pretty stable and has decent returns overall. The second ETF is the MSCI World Emerging Markets. This ETF covers the emerging markets with a heavy emphasis on China, Taiwan and India, with these three countries contributing to almost 60% of the companies in this ETF. The companies in this ETF have great potential, but only time will tell if the potential is achieved or not. The third ETF is the S&P 500. As I mentioned earlier, this ETF tracks 500 of the top companies in the US. So the diversification is a bit limited with this ETF, but looking at the policy set by the US government, companies in the United States will grow faster than any other countries, at least in the near future. I know as a beginner it is very difficult to choose the right ETF. So in this video, I share my 7-step strategy of exactly how I would start investing if I could start over. So thanks for watching, bleibt gesund, and I'll see you in this video.